Welcome to the Politics of Everything. I'm Amber Daines, your host and podcast producer. This is a half hour of power, a podcast dropping every week where I unpack the politics of everything, from money to motherhood, nutrition to narcissism, startups to secularism, the environment, quality, and much, much more. Our guests are seasoned in the field or topic of their choice, even if you've not heard of them yet. This is a non-partisan show. So while I love exploring varied views and get a buzz from a healthy debate of ideas, this is not a purely blue, white, green program. Please subscribe, tune in and enjoy the politics of everything. Property investing has become both a political hot button topic in Australia, where we have some of the world's most expensive housing, especially in our capital cities, as well as a great way for, say, mum and dad investors to build wealth. Safe as houses, as the saying goes. Then there are different types of investing, basically some residential, which most of us are familiar with, and commercial property investing. And I guess that's our topic today, the politics of property investing. So I'm chatting to Scott O'Neill. He's the managing director of Rethink Investing, and he had a big shift himself from civil engineering to property investment, achieving financial independence by the age of 28 with a commercial and residential portfolio valued at around 80 million Australian dollars. His dedication to mastering the nuances of the real estate market has propelled him to the forefront of his industry. His dedication to empowering investors, whether they're new or experienced, towards financial freedom is exemplified through his contribution to top commercial property podcast, Rethink Investing's Inside Commercial Property Australia. And he has a book, Rethink Property Investing, as well as an educational platform, Rethink Commercial Education. He cultivates a culture of learning and growth, aiding Australians in their pursuit of financial independence and freedom because of his expertise. So I warmly welcome you, Scott, to the Politics of Everything.
Great to be here, Amber. Thank you.
Podcasting remotely can be challenging, but it doesn't have to be. Since day one of the Politics of Everything, I have relied on Zencastr's all-in-one solution to make the process quick and painless, the way it should be for those of us who just love great content and want to get our ideas out into the world. If you know me, I'm obsessed with quality in terms of my guests, my sound, and everything about my show has to be great the first time. I'm time poor. It's so easy to use Zencastr. I'm not tech savvy and you don't need to be either. There's nothing to download. Just click on the link and off we go. Zencastr is all about making your podcasting experience easy, and with everything from local recording to automatic post-productions now in their toolkit, you don't have to leave your browser to get that episode done, and done fast. I have a special offer for you, and hopefully you can experience what I have with Zencastr. Go to zencastr.com/pricing and use my VIP code, the Politics of Everything, all lowercase and one word, to get 30% off your first 3 months of Zencastr Professional. How good is that? I want you to have the same easy experiences I do for all my podcasting and content needs. It's time to share your story. Okay, young Scott, did you think you'd be a property mogul? What did you think you'd be as a kid, and kind of join the dots for us?
Well, I definitely didn't think I would really, get to anywhere near this level with property. But I guess I saw my parents dabble in it. They were the old negative gearing style investors. And I just saw it firsthand how that structure didn't really work. They were kind of tied to their jobs. And yes, they had a few assets under their name, but with the cash flow and the very strategy of negatively gearing meant cash flow was quite limited in our family for, probably compared to what they were earning. So I just felt like that wasn't a way of getting ahead. So yeah, it was always about getting a good job. So, went to school, studied hard, went to Sydney Uni, got a bachelor's degree in civil engineering and construction management. And that was really just to get me into engineering. And I picked the job for two reasons. One, I like the idea of not sitting in an office all day. It was good to, I like the idea of getting into a construction site and moving around, seeing the world a bit. And the other reason was it paid pretty well. So, I didn't want to just pick a degree that, was going to restrict me from an income point of view, because I knew, seeing it with my family, that income was important to have a comfortable life. And that's sort of why I went down that career initially.
Excellent. I love that. And it's good to know your backstory as well. So tell us a little bit about, I guess, not just property investing, but how it's changed in the past decade or so, and what that really means today for commercial investors and maybe other property investors as well, because like all markets, it doesn't stay static and there are changes. What have you really witnessed?
Look, I witnessed the old rules of investing don't really work anymore. And this is one of the reasons we've just got such a large amount of resources in the companies I've created dedicated to education. So you've noted, the books, the podcasts, even the online education platform. And it's all to do with helping people understand the commercial markets, because I'm a big believer that you need both residential and commercial property to really retire well and comfortably. Like the old method of just focusing on residential property, it does not work like people promise, and it's due to the cash flow. Like people are buying 4 to 5%, gross yielding type properties, and the interest rates are 6 and 7% as we speak at the moment. You're sure they'll come down, but the yields are just not sustainable to build an efficient passive income anymore. And it doesn't mean you don't get into residential property. It's the greatest starting point, because you can leverage 90% of the income, sometimes even 95%. So you can get in with smaller deposits, let the leverage do its thing over time. But the trick is you don't keep going down that path, because you'll end up like everyone else, just with a large debt and relatively modest income, and you're just hoping for capital growth. And that can take decades, multiple decades, to really get ahead. And a lot of the experts that are in this space telling you to follow this process actually rely on business income themselves. Like they're not truly retired, even though they say they are.
And how would you know, I guess, right? Because they're not going to necessarily open up their books for you and show you exactly what that position looks like, for example.
And that's such a good point. And talking about the politics of things, this is one of those controversial points that there is a lot of people in the industry that they can fake it until they make it through their business income, or like they said, there's no disclosure required when people advertise, particularly in some of these industries. So you don't know what you're dealing with. It's just advertising, and there's very few people that would really open their books to their clients, and that's why I think there's a lot of question marks with that strategy, because we don't know the true numbers. And I've gone on record with my portfolio, like I've been in the AFR Rich List, and they actually look at your rental statements.
Oh, totally. It's very forensic. I used to work for the AFR. Yeah, you can't hide there.
Exactly. And it's amazing. There's a lot of people in the industry that would state they've got very big portfolios, but mysteriously they're not on any of these public type records. So that's evidence that there might be a little bit of tall tales being told. But I think it just goes back to the point that the residential portfolio where they just, acquired 20, 30 houses of, middle ring suburb type houses, it doesn't solve a retirement problem. It creates debt, and it does create wealth. So I'm not kind of putting it down to a bad strategy where it doesn't make you money. It will. But if you're looking to build a passive income and actually retire, I don't think that's the strategy that can be followed like it could have 10 years ago.
It's interesting, isn't it? Because it's become, I guess, an easy way as well. Like people understand it. It feels very logical. And if you're heading towards retirement, obviously you're thinking about those things like passive income, but also there's tax benefits, I guess, of having properties or exiting properties at that time of retirement. But like you say, having lots of debt is not always something that everyone wants, and it probably keeps people awake at night, particularly with interest rates being what they have been in Australia for the past couple of years. It's not necessarily something where people can rest easy and hope for the best, and hope that the market keeps going up and they keep having money on paper.
Exactly. And I guess the point is everything that, the benefits of residential property, we've done a lot of education on the fact that those same benefits are in the commercial markets. I actually commissioned a study into the long-term growth rates of commercial properties around Australia for every asset class and every capital city. And the interesting data that came out of it, it showed roughly 5 to 6% average capital growth rates for industrial, office, and retail. And it was only about half or 1% less than residential over that long period. It was from 1995 to 2022. Yet the cash flow was 3 times as much. So if you look at it from an overall return point of view, commercial was superior. And, obviously we've got to talk about the higher risks and that type of stuff.
Yeah.
But there is capital growth.
Pick your brain on that. Absolutely. So just tell us, in your view, how is commercial property investing different or not different from that residential investing market, and that belong on the stock type. Obviously, we're talking, residential houses versus it might be in a business park or a medical facility or whatever. That's neither here nor there for me. What I'm trying to get my head around is, I guess, what's the difference in the investment strategy or the rules, or is it not really that different?
Look, super high level. Basically, we're looking at different types of properties where businesses operate, and that can include industrial, office, childcare, service stations, medical centres, all that type of stuff. There is slight differences in lending, good and bad. The good is you can actually get things called lease stock loans, which means you can service the loans even if you don't have a job, where you just got the deposit because it's a loan on the lease. So if you reach a serviceability limit in residential, which is quite common for those with a large negatively geared portfolio, you run out of steam in the bank size. Once you run out of steam, commercial can still be an option for you. So that is a positive. One of the negatives is the lending, because you've got to put a larger deposit in. I actually don't think this is a bad thing once you get to a certain level in wealth or retirement stage, because you don't want to be sitting at 80% or more of debt as a proportion of your investment value, because it does get riskier if you sit at those debt levels for long periods of time, like we've seen with the recent rate rises. Where people that have taken a 95% loan on an apartment in Sydney or Melbourne, they're probably feeling the pain a lot, and there is a lot of forced selling going on at the moment. Commercial, you're looking at more of a minimum 30% cash down. So there's a lot more cash you've got to put into it, but that actually will, in a way, create a bit more stability because, basically there's more cashed up investors that can weather the storm more when rates increase. And remember, the cash flow is better as well. So the other big difference is the pattern of vacancy. So with residential property, the pattern is you're going to get more frequent vacancies. Could be annually, every second year, because tenants come and go a lot faster, and you'll fill them quicker. So you might, in a good market, fill it within a week or 2 or 3 weeks. But then you might have to do that every year. But commercial, you might have a 3 to 6 month vacancy, but that might be only once every 10 years. You might get lucky and buy the local medical centre and it's there 40 years later, or fast food restaurants or childcares. Like, it really depends on the quality of the commercial property. But the pattern is less frequent vacancies, but longer when they come. So you just got to be, prepared for those events.
Absolutely. I love how you've explained that so simply as well. It really does make sense. Is being a high net worth individual mandatory to get into that more commercial type of property investing? Sometimes, if you're talking about medical facility, we're talking hundreds of thousands or millions of dollars. Or are you doing it as part of a group or a syndicate? Like, is there a way to get in there if you're not necessarily someone who has a lot of spare money or high borrowing capacity?
Look, it's a great question. And the answer is you do not need to be high net worth. Like, we, as a company, purchase at least 10, sometimes 15 properties per month under $1 million. These are commercial, industrial units, small, retail type places. Even like, we bought a dentist once up in Brisbane for 220 grand. Like, it doesn't really, like, a lot of the value of commercial property is dictated off the rent, and the rent is dictated off the square meters available. So you could imagine a small commercial property from a square meter point of view. By the time you multiply the rent out and then value it from there, it can be quite cheap. They're just going to be smaller. So they don't necessarily mean they're going to be poor quality. These more affordable commercial properties, they're just going to be smaller ones. And that's why the warehouse type arrangement, where it might be 200 square meters, that's quite small. It might be part of a strata complex in, near an airport in one of the capital cities. They could be cheap, a lot more affordable than the average house price in the area. But you can purchase them in syndicates, and you can also obviously go much higher value, like almost unlimited. You can spend a lot more on commercial than you could ever on a house. Like, you see the richest people in Australia buy $100 million homes. That in a commercial can be quite small. You can see $1 billion properties quite often in the commercial space. So again, it's size and location and the amount of rent that dictates the value of the commercial asset.
Since 2015, your firm has assisted around 4,000 clients in acquiring over $4.25 billion worth of real estate, strategically positively geared, high cash flow investment, and that seems to be, working for you. Can you just share for us, I guess, your ethical and strategic approach to this business? Because there are other people who do what you do, Scott, but obviously you've got something magic that's happening as well. But, is there an approach and a philosophy you have that might be beyond just the numbers?
Look, I guess, first of all, I set this business up after my wife and I effectively retired from our jobs. Like, my wife was in financial planning and then got into marketing, and I was an engineer at the time. And we built an income up that replaced our incomes at the time. And it's only after that people started asking, what were you doing? Like, we were in Europe for 6 months straight, and questions were being asked. And then, I guess it was a job formed off helping people buying the types of properties we were buying. And this changed over the years. Like, we were a lot more residential focused, but we're into unit blocks and duplexes and whatever it took to get a higher yield out of a residential property back in the early days. But then we shifted more towards commercial because the numbers made sense. So to answer your question, we're very numbers driven. It's the only way to invest, I think. There's very little emotion in this, to the point where we don't care if a deal goes ahead or it goes through. It really just depends on, does the market make sense? Do the numbers make sense for the client? Are we buying it well versus the market? Does the cash flow make strategic sense to acquire this debt for the client? Look, the numbers have kind of come through over the years. We were one of the first to get into this space, but we've really held our market share just through deal quality. So our mantra is, like, we only send a property to a client if we'd buy it ourselves. And that has really extended through, we've got about 70 people working here now, and about 1/3 of them are previous clients. So people that have actually, gone through the process as a Rethink Investing client. They've done the due diligence with us. They've acquired multiple properties, and, they develop passions for it, because property often does that. Like, it's a bit of a hobby type industry. Like, you do it almost, as a sport. And like a lot of people, once they've done their round of buying, and, some of them are completely retired, instead of starting their own thing, they've joined us.
Nice. Well, that sounds like you're doing something well anyway. What are some of the biggest mistakes that you see investors make? And, it may be things like the cliches, the old styles of investing, that idea of blue chip investing only in sort of, places which have great postcodes or trendy locations or shiny new business parks and things like that. Are there things that you when you're advising people, you kind of debunk some of those myths really for them?
Yeah, so I guess one of the ones that I see early investors do is they take advice from people that are not in positions they want to get into. So, they might get advice from their accountant or, someone that's only bought one or two properties, saying this is what you should do. And they end up just following the complete wrong strategy. That's super common. It'll always be common, unfortunately. People just take advice close to them, whether it's their parents or, just someone, as I said, that hasn't really gone through the whole process of, being in an ideal position from property. And the other thing is, like, on the other end of the scale, I see a lot of very high net worth investors almost look at things from a tax point of view rather than a building wealth point of view. An example is this. I had a guy the other day, he's looking to buy a $10 million property, and he was like, oh, that property is making me too much money. It was 300,000 positively geared, and he was thinking, oh, I've got to pay tax on that. So he would rather lose 300 grand and get a bit of it back in tax return time than make 300 grand and then pay a little bit of tax on it.
Wow.
It's a completely back the front strategy. It just shows that, like, it's almost even hard to relate. Like, what do I even say to that?
I know. Well, if my accountant always says, if you're paying a decent amount of tax, it means you're making money. So it's not all bad. I guess tax minimization's in some people's strategic view and, whatever. But I hear you if it doesn't make much business sense when you do those numbers.
Yeah, it's like I wrote it in our book. Like, you wouldn't go out to acquire a cafe business that was losing 100 grand just so you can get 30K back.
Yeah.
Like, you'd buy the one that's producing 100 grand income, and then you pay 30 grand tax. Like, you're 70 grand ahead instead of being negative 70 ahead. Like, it's almost basic mathematics, which is lost on some. And it's a very common train of thought, which is why the people would then go buy a negatively geared portfolio, because they're often protected by another income. But if their job is to make wealth from this, you're better off almost not investing if you're going down that other path.
Absolutely. They're kind of at odds with each other by the sounds of it in some ways. Your favourite business tool at the moment, and how is it helping you?
Look, I've really enjoyed giving back through the education side of things, like even the course that we run. Like, if I'm being honest with you, that's not a business that makes money. Like, it covers its costs, and it's really about just creating a larger ecosystem of investors that understand commercial property. Some come as clients, some go buy their own properties without us, but it's just creating more awareness on an asset class that's changed my wife and I's life. Like, without commercial property, I dare say we'd still be working. We'd have decent jobs, but it would have been a totally different life because I would have kept investing. Like, it's pretty addictive. Most property investors don't stop if they can keep going. And one of the things if we kept building that large residential portfolio, especially now that interest rates have gone up, like, it would be costing a lot to hold that thing. So
Yeah.
I'd be relying on my job and my wife's job to support the debt on that, especially from the bank sides, because they've got serviceability criteria well above the average interest rate. They might have 2 or
Absolutely.
3% above that we've got
Yeah.
to then service. So yeah, commercial just fixed all that. So just try educate people that don't go down that well-trodden path of only investing in residential, because there's 10,000 guys and girls in Australia telling you to do that, and it's because they may have vested interest to keep you going down that path, whether it's the mortgage broker to get more debt, whether that's there's all sorts of reasons, but we want a balanced view. Like, I will say go down both. Residential makes more sense if you're got younger, you might have time up your side, you might want to put less money into a deal, you might have a less of a need for the cash flow right now, so put it away, leverage up. That's where residential makes perfect sense. But there is a time, against what society tells you, you need to stop investing in residential and come over the fence to commercial.
Absolutely. Your biggest life lesson to date, and what has it taught you?
Oh, good question. I think, look, the older I get, it's time and energy is such a limited resource. So I made the mistake of just working too hard, and I'm sort of in that stage now. But I want to, we got to remember the goals we set early on. And one of ours was we wanted to spend 3 months overseas every year, especially because my she grew up in Greece and her family lives there, so we don't have much family in Australia. So just spending time off out of the business, it's definitely cost me a lot in terms of potential growth and revenue, because when you leave a fairly fast growing business like mine, it does put the handbrake on it. And we decided that growth at the cost of lifestyle is not the answer.
Yeah.
And
I
that
think that's
the
fair
older you
enough.
get, the more you realize that.
Absolutely. And that probably leads into my next question is, how do you define your own version of success?
Yeah, look, it's freedom, and I feel like I'm not stressed ever when in terms of financial performance. Even with the business, like, it's like if we have some deals crash over or there's something bad happens, like, and you've been working on a project for a while and it doesn't work out, it doesn't matter like it used to. Like, I remember when I was a startup and things were a lot more on the edge, that you think differently, you make different decisions. That's the reality of it. But we become more conservative and less in a rush when that happens. And I've almost found that's kind of promoted growth to a degree, but it's not forced growth. It's more organic and word of mouth and all that type of stuff. And that's probably how we've kind of kept our position in the market, while others may be working a lot harder or trying to force the issue. We sort of we let people come to us to a degree. And yeah, it's been a good journey, but every year in business is different, and that's the exciting bit now.
And just a final message for us on the politics of property investing.
Look, I think the final message is just, like, everyone starts from a different position and ends up, and you just got to work out what your goals are. Like, there's a lot of people that measure the success off the base of others, including myself. I might see a business or an investor that might have substantially more. In the early days, I was like that. You're measuring yourself against others, but now I barely look at what competitors or others are doing, because I'm content where I am. Like, it's where I wanted to be, and I speak with many investors that may have a lot less than myself, but they're equally or even more happy because they've set their goal of buying 3 properties and they might travel Australia in a camper van and with their kids, and that's their goal. So the main message is everyone just have their own goal. Don't worry about what others are doing, because if you hit your goal, that's one of the, at least for financial happiness, that's how you get it.
Fantastic conversation. If you do want to connect further with Scott and find out more about his business, there are details on the show notes. Until next time, take care. Thanks so much for listening today. If you've enjoyed the politics of everything, I thrive on your feedback. So please add a short review and share the podcast with your network through Apple, Spotify, and all the usual suspects. I'm always on the hunt for new and diverse guests. So if you or someone you know has a fresh idea you're busting to get out there, please email me at amber@amberdanes.com and my crew will get back to you very soon.